Welcome back, dear listeners. In this video, we are going to learn the concept of depreciation and its different methods. So, what is depreciation? It is the systematic allocation of cost of an asset into expense over the useful life of an asset. For example, you buy an asset and systematically with a certain percentage or with certain mechanism you depreciate its value. The asset gradually decreases its value due to some usage or wear and tear. So the gradual decrease in the value of the asset which you systematically allocate from asset to expense is known as depreciation. This diagram will help you to understand how it will be treated in accounting books. First of all, asset is recorded in the balance sheet as non-current asset, and with the passage of time, with the gradual use of asset, its value decreases over the years. So the whatever the value decreases, it should be treated as expense. So systematically we are recording the asset into expense over the useful life of an asset, which is basically the concept of depreciation is. Next, we learn the book value of the asset and accumulated depreciation. Book value of the asset is any cost of asset minus its accumulated depreciation. Accumulated depreciation is the total of all previous year's depreciation including this year. So accumulated depreciation is a contra asset account. Contra asset account is temporarily opened just to offset the asset, and its normal balance is opposite to asset account. Because contra asset account is opened just to offset the asset, because during the life of an asset we cannot record asset as credit. Asset is recorded as credit only when asset is disposed of, or it is revalued, or it is having no more value. Contra asset account is opened temporarily just to offset the asset during the life of an asset. So it is the amount which represent the cost of depreciation allocated up till now. We can use two types of model in recording the depreciation. One model is cost model and other is revaluation model. Under cost model of asset, we use this formula: cost of an asset minus accumulated depreciation minus any impairment loss. With the cost model, asset is carried at cost less accumulated depreciation and impairment according to International Accounting Standard number 16, paragraph 30. Under which revaluation model, the asset is carried at revalued amount being its fair value at the date of revaluation minus any subsequent depreciation and any impairment loss, provided the fair value can be measured reliably. Under revaluation model, revaluation should be carried out regularly so that the carrying amount of an asset does not differ materially from its fair value at the balance sheet date, whereas under the cost model it is not so. Here is a worked example for the method which is straight line method. It is also known as original cost method because every year depreciation is charged on its original cost. On 1st January 2005, micro company buys a new machine. It pays 20,000 for machine. So this is cost of an asset, and its residual value which is expected to be realized at the end of its estimated life is $2,000, and the estimated useful life of the asset is 5 years. So we have been given three information: cost of asset, scrap value, and estimated useful life. Under straight line method, we can use the formula to calculate per year depreciation. So here we go. This is the formula for calculation of depreciation per year under straight line method. According to this formula, 20,000 is the cost of asset minus scrap value over useful life. This will give you 3,600 per year depreciation. Now I will show you the calculation how it will work. On 2005, the journal entry will be made like this: depreciation expense debit, accumulated depreciation credit. So in the first year, accumulated depreciation is 3600. How can we calculate carrying value? Carrying value or book value is same thing. Cost of asset minus any accumulated depreciation. So cost is 20,000 and accumulated depreciation is 3,600. So by reducing 3,600 from 20,000, this will give you 16,400. Next year we will calculate depreciation equal amount because this is straight line method. And how to calculate carrying value? This is apparent. Cost of an asset 20,000 minus accumulated depreciation. This year accumulated depreciation is 7,200 because 3,600 for this year and 3,600 for previous years. So accumulated depreciation is deducted from the cost of an asset, and it gave us $12,800 as carrying value, and it will go on for next years. If you look at the last year working, the depreciation expense is same because straight line method, and accumulated depreciation becomes $18,000 because last 4 years depreciation was accumulated 14,400. This year depreciation 3,600. It became 18,000 total. So last year the scrap value left $2,000. Now we will see the diminishing method of depreciation. Another name of diminishing balance method is reducing balance method or written down value method. On 1st January, A Star company buys a new machine which cost is $20,000, and the rate of depreciation which is given to us 20% per annum, and the company closes its financial year on December 31st every year. Show all relevant computation. So here you can see the relevant computation just like same as we discussed few minutes ago. So in 2005 you can see depreciation 4,000 which is 20% of $20,000. So we calculated 20% of 20,000 which gave us 4,000. So we passed a journal entry depreciation expense debit and accumulated depreciation credit. As you already know carrying value how it is calculated. The accumulated depreciation is deducted from the cost of an asset if we are using cost model. So our carrying value at the end of first year is $16,000. Next year we will not calculate depreciation on its original cost. We will calculate depreciation on the carrying value or the book value of the asset because of diminishing balance method. So 16,000 times 20%, so which gave us $3,200 in second year depreciation. So our accumulated depreciation became 7,200 at the end of second year because first year depreciation is 4,000 and second year depreciation is 3,200. So accumulated depreciation became 7,200. So when 7,200 is deducted from last year, 7,200 is deducted from cost of an asset, it gave us $12,800. So our carrying value at the end of second year is 12,800. Next year in 2007 you can see again we multiplied 12,800 with 20%. So we took 20% of 12,800 which gave us $2,560, and accumulated depreciation became $9,760. How it is calculated? 2,560 for this year and 7,200 for last 2 years. So accumulated depreciation became $9,760, and the carrying value is calculated under same mechanism, cost of an asset minus accumulated depreciation, and our cost of an asset is 20,000 and accumulated depreciation is 9,760, and our carrying value became $10,240, and so on. And the last year the carrying value is 6,554. So here we discussed our straight line method and diminishing method. If you want to have more such videos on accountancy, just subscribe AZ Accountancy YouTube channel. Thank you very much for listening.